Welcome, everyone, to Talking Textiles. This podcast is brought to you by the Advanced Textiles Association. My name is Charlene Clark, and I'm the Vice Chair of the ATA Marine Fabricators Association Advisory Board and the CEO of Signature Canvas Makers. I'm your host for today's discussion. Thank you to everyone listening in on today's episode. The goal of this podcast is to get to know the wide variety of positions and markets that make the advanced textiles world turn. We will be talking to professionals in different roles throughout this series to help inspire the next generation of textile professionals and anyone interested in learning about others' journeys in the world of textiles. ATA offers advanced textile content throughout the year, including the upcoming Smart Fabric Summit, an event where government, industry, and academia meet, happening on April 11th and 12th, 2023 at the North Carolina State University in Raleigh, North Carolina. Visit www.smartfabricsummit.com to learn more. Today, we are talking about ESOPs. An employee stock ownership plan is an employee benefit plan that gives workers ownership interest in the company in the form of shares of stocks. And now, let's talk textiles. Hi, I'm Charlene Clark, and this is Talking Textiles, where we talk to successful companies on their experiences in the industry. On today's episode, we'll have a panel discussion about employee stock ownership plans, or ESOPs, with Doug Neville of the law firm Greensfelder and Dave Bess of Lawrence Fabrics and Metal Structures. Welcome, everyone.
Thank you, Charlene.
Thank you.
Thank you, gentlemen, for joining us today. Doug, let's start with you. Give us an idea, define what an ESOP really is and how it works.
Sure thing. And first of all, thanks for having me here today. I'm glad to be talking about this. So, and I'm approaching this from, as a lawyer, from kind of the legal perspective. So that'll be kind of my angle. But from the legal perspective, an ESOP is really just a qualified retirement plan. So you can think of it in terms of other types of plans, like a 401k plan or a profit sharing plan. A lot of employers have those types of plans. And so it's really just a type of plan that is similar to those with some unique features. The thing that is really the distinctive feature that sort of separates an ESOP from those other types of plans is that it's designed to primarily invest in the employer securities, the stock of the company that's sponsoring the plan. So that's really the one feature that sets it apart from other types of qualified plans. In terms of who can sponsor an ESOP, almost exclusively it has to be a corporation that does it. I think maybe there's been one or two LLCs that have been taxed as corporations that have gotten private letter rulings from the IRS that have allowed them to set up an ESOP, but that's not what we typically see. Typically, it's a corporation. And so it can be either a C corporation or an S corporation that can establish an ESOP. And we see quite a bit of both, although S corporation ESOPs have become a lot more popular in recent years for various tax reasons that we'll probably get into. In terms of the governance of ESOPs or the rules that govern them, there are two primary sets of rules. There's the Internal Revenue Code, the tax code, the federal tax code that governs sort of the taxation of the ESOPs. And then there's the Employee Retirement Income Security Act, which is part of the U.S. Labor Code. And that's the reason I say that is because it's important, because you have two sets of federal agencies that pretty highly regulate these types of arrangements. You have the IRS and the Department of Labor, and there are a lot of technical requirements that go into setting up and administering an ESOP, and you have those two organizations, those two regulatory agencies that are kind of looking over your shoulder. So it's really important that when you set these up, you're making sure you're adhering to all the various requirements, and because you will have these regulatory agencies looking over your shoulder. So that's kind of the basic of what an ESOP is.
Great. So there's obviously some very specific requirements that would be needed for a business to venture into offering an ESOP. What are some of the things that, aside from being an S Corp or a C Corp, are there other, is there size requirements that would be needed?
Yes, there are. There's no, from a legal perspective, there's no minimum size requirement, but there really are practical limitations on what types of companies or how big of a company can offer an ESOP because of certain limits on contributions. What you typically see is that if you have under roughly 30 employees, an ESOP really isn't very practical. So for very small companies, just from the ability to comply with various legal requirements and limitations on contributions, things like that, it really just doesn't work for smaller companies that are below about 30 employees. What we typically see, though, is that's really kind of an absolute minimum. Usually we see 40 or 50 is kind of the lower limit that we typically see. And by the way, it's not impossible to have very small ESOPs with fewer employees than that, but it just typically is not what we're seeing. The other piece of that, I think, that is that comes into play is that setting up an ESOP, because of all the technical requirements you have to comply with, because of the regulatory oversight, you really have to carefully plan these transactions and make sure that with ESOPs and make sure that they're set up properly. And so, in addition to being the sale of a company, you have a company that's essentially being sold to this plan. So you've got a corporate transaction that's going on, but on top of that, you've got quite a bit of regulatory work that you have to put into the transaction. So it adds to transaction costs. And so if you've got a really small company, a lot of times the transaction costs are just too great to do an ESOP. So those are really two kind of more practical reasons why you don't see smaller companies that are sponsoring these types of plans.
Okay, great. So Dave, I'd like to hear from you a little bit. So your company obviously has an ESOP. So tell us a little bit about why you chose to go that route, and what are some of the advantages both to the business and also to the employees?
Yeah, Charlene, thanks for having me on this podcast. And Doug, thanks for joining us also to help correct any maybe technical errors I may speak to. You can jump in and correct me. So Charlene, when we looked at the deal, the former owner of our company was Jerry Grimad, and he had witnessed in prior years transactions happen that were not successful, whether it was companies he was aware of or companies we did business with. Some of those were sold to individuals or private equities, and he saw the business fracture afterwards. A lot of employees left. And I think the allure for Jerry was that he would be able to maintain and have some legacy at the company, right? He would be able to sell to the employees. The employees were able to then have ownership within our company. And that's exactly what happened. Shortly after we did our deal, the employees started to understand what ESOP was like. And it's not something that happens overnight. It's something you have to work with year after year. But we're definitely starting to see the benefits of an ESOP and employee ownership. Been just a change of mindset.
I imagine it's quite a culture shift for both the employees and the business owners.
Yes, it has been a culture shift. You go from day in and day out, you're working for the president of the company, the owner of the company. And when that shifts, and now the employees, not that they weren't working hard before, But when they start to realize that we're working together for the common goal, for all of us to have a better retirement, I think people naturally start working a little bit harder, a little bit smarter, and start working a little bit more as a team naturally.
Excellent. So in terms of setting up an ESOP, are there, I'm sure there's upfront costs or, things involved. Obviously, there's a extensive, Doug, you talked a lot about the technical requirements and things of that nature. But are there upfront costs involved for the employees, or are most of those costs set up geared towards the business?
I think I'll take this one. Yeah, the employees don't really have an upfront cost in setting up an ESOP. It's typically the business owner or owners that will start exploring an ESOP, and the company usually is the one that bears the expense of that. It's possible that the owners may bear some of that expense themselves, but the employees of the company don't have to contribute in any way to setting up an ESOP. So when an ESOP is established, there are certain transactional costs that come into play. There are fees that get paid to professionals to help evaluate whether or not an ESOP is the right fit for the company. There are legal fees that go into it. There are typically accounting fees, because you're looking at projections, financial projections, to see if the ESOP is feasible. So all of those types of expenses are typically borne by the company, and it really doesn't impact the individual participant or the individual employees in any way, or hit their financial interests in any way.
Yeah, and I think from the company perspective on that, Doug, yeah, you do have the initial onset of cost, and then there's, Charlene, there's additional cost year after year, right? You have to perform evaluation of your company every year. There's third-party administrators that we use that you pay for their services annually. But we really see the benefit of the tax advantage outweighing those costs towards the company. So definitely was the right move for us.
And how does the vesting process work with an ESOP or distributions?
Well, it's kind of a loaded question, right? I mean, when I ask around at all the conferences, we talk about different distributions and plans, and there's not a lot of plans that are set up identical. I think just about every plan is unique to that business, but I'll let you speak to that generically, I guess.
Yeah, so I think really where we almost have to take a step back, I think, to address that question, and I think where you start is how the ESOP gets set up and how stock gets into the ESOP. So really the first step in the process is, again, you've got an owner or owners who are interested in selling the company. And typically they'll evaluate a number of different options: selling to a third party, selling to a private equity group. And an ESOP is typically one of the potential options. So for those that go with the ESOP route, the owner or owners will sell their stock to the company. The company typically gets financing to do that, and so there's a loan that is established between the ESOP and the company, where typically the company will borrow money from a bank, or a combination of a bank and the sellers, the selling shareholders. And then the company will turn around and loan money to the ESOP so that the ESOP can buy the stock from the selling shareholders. So at the end of the day, you've got ESOP owing money to the company, and you've got the ESOP that has the stock of the company that's held in the ESOP's trust. So what happens is, as that loan between the ESOP and the company is paid off, and it's paid off by the company making contributions to the ESOP, which the ESOP just then turns around and pays those contributions back to the company so that it can service that loan and repay that loan. As that happens, the stock that the ESOP owns is released from something called a suspense account, and it's allocated to participants, usually pro rata based on their compensation. And so over time, as that ESOP loan gets repaid, the participants will get higher and higher balances of ESOP, of company stock in their ESOP accounts. So that's how the stock gets into the participants' accounts. Then the question is, really, it goes to, okay, how do they vest in those accounts, and how do they ultimately get distributions? As Dave mentioned, there are a lot of different ways to do it, but typically what we see is that you have vesting over a period of years. Typically, a typical vesting schedule may be 20% per year over a 5-year period. You can also do what's called a cliff vesting, where you're not vested at all for the first 3 years, and then after 3 years, you become 100% vested. And so, again, and you could do it different ways. You could do 25% per year for 4 years, but typically those two basic vesting schedules, the 5-year sort of 20% per year, or the 3-year cliff vesting, is typically what we see. And then in terms of distributions, what usually happens is there aren't any distributions that get made until a person reaches either retirement age or terminates employment with the company. So it's not like employees have the ability to just cash out at any point. It's not like a savings plan where you could take in-service distributions typically. It's something that really is designed to provide retirement income. So what you see is the amounts that are accumulating via the value of the stock in accounts. Those get deferred until someone terminates employment or reaches retirement age typically. And there are some exceptions to those general rules, but that's really how the distributions typically work.
Wow. So it sounds like this is something that a business does not want to enter into lightly. And Dave, you and I had talked a little bit prior to the start of the podcast about how long it took for your company to make the decision to have an ESOP. Talk a little bit about that, the kind of research and how ultimately you came to the decision.
Yeah, Charlene, when the former owner of the company, talked to us about his, future retirements, he laid out a couple of ideas, and, a transaction with an ESOP was one, selling to a private equity was another, or selling to Mike and I, right? He offered us to buy the company. Well, Mike and I didn't have quite the funds to purchase the company at the time. We were not interested in private equity at all. So we really started thinking that the ESOP deal might be the best avenue for us. So we started calling people we knew. We started doing research to find out what other ESOP companies were in our local area. And we quickly found out there are 2 national associations which have annual conferences every year, where you can go and attend that conference to learn about ESOPs. They'll cover anything from starting up an ESOP for someone that's new. They'll speak to cultures of ESOPs, and they'll speak to mature ESOPs. So we started attending conferences about a year before time. We attended a national conference out in Denver, and we got really excited after attending that conference that this was going to be a good fit for us. We realized that our employees were not going to have to dip into their savings, that we were going to be able to get financing, and that this was going to be a true method for ownership for all of our employees. And we just thought we couldn't work for a better company than a company like that's structured with ownership within the employees.
So, and this is a question for either one of you. Are there organizations, you mentioned, Dave, that there were some organizations. If someone was interested in just starting to do some initial research, what are the resources that are available to them for that?
So Doug, I'm aware of NCEO and the ESOP Association. Are there any other organizations out there that people could reach out to?
Those are really the two primary ones. And they're both the NCEO is probably a little bit broader in its scope. The ESOP Association is, as the name suggests, pretty much focused 100% on ESOPs. NCEO is a little bit broader, although most of the discussions that go on there also revolve around ESOPs. So I think those are really the two primary organizations that I would recommend if somebody's interested in exploring, the possibility of an ESOP. They've got, as you mentioned, Dave, they both have annual conferences, which are great. They're very large annual meetings that have a lot of different sessions for pretty much anyone in the process. Just someone who just initially exploring to somebody who just set up an ESOP, like you said, mature ESOP. So a lot of resources available there. And then there are also smaller regional conferences that you can go to that are closer to you. So I would recommend one of the two, or one or both of those organizations.
Great. And for those that may not know what NCEO, that is the National Center for Employee Ownership.
Correct. Yeah, and Charlene, the other bit of advice that we received at those conferences that we attended, they told us, they said there's a lot of lawyers out there that claim they can do an ESOP transaction, but there's really only a select few that are good at them. So that's probably going to be your first step, right? Once you attend a conference, to start looking at someone that you can partner up with to start understanding all the legal ramifications of a transaction.
Excellent point. So, gentlemen, are there any other key points that we have not discussed, or any other items that you think our listeners should be aware of?
I think one thing that, and Dave, I think you hit on this, but I kind of just wanted to amplify it a little bit. In terms of the businesses that this type of, that an ESOP is appropriate for, what we typically see, I would say out of maybe 10 or 15 companies that approach us with an ESOP, we usually see maybe 2 or 3 of those actually going forward with it. It's really not a fit for every single company. And as we discussed before, sometimes the company is too small in terms of their number of employees or maybe the value of the company. Again, just because of the transaction costs, if you've got a company that's worth, say $3, $4, $5 million, it's not impossible to do an ESOP, but the transaction costs can sometimes make it somewhat, just not efficient to do it in that range. So that's one consideration. Most of the companies we see that are doing ESOPs are somewhere north of $5 and probably these days $10 million in value, and then they go up from there. So that's one consideration. The other consideration is really just and Dave, I think you really hit on this, but what are the motivating factors for the selling shareholder or shareholders? If you have an owner who simply wants to maximize their value, maximize their sale price, that may not be the best fit for an ESOP. Usually what we see is, in terms of ESOPs that end up succeeding, is you've got somebody who wants to, maybe who has built a business, who has got loyal employees that they want to reward and really leave a legacy for the business and for their employees. And so that's one factor. There's sort of almost an altruistic factor, I think, that we see that where these tend to work. And the other thing that goes hand in hand with that is the big thing I think that makes ESOPs works is this concept of an ownership culture. And a lot of times if you do have somebody who's owned the business, who's built it, who's got kind of that maybe an altruistic mentality, wants to help and reward their employees, they may have built a little bit of that type of culture to begin with. There may be a lot of loyalty among the employees. And so an ESOP might work better in those situations where, you've got somebody that's looking to, to kind of benefit their employees, and you've got a group of employees that's sort of loyal to begin with. So those are a few just kind of non-legal, but sort of important subjective factors to consider when looking at whether or not this is the right fit.
Yeah, great, Doug. As I listen to you speak about that and about the deal and the transaction and the former owners, I would assume, Charlene, that the owners of businesses are going to be watching this podcast, right? So, Doug, I think that's part of the reason some owners do sell an ESOP is there is a tax benefit to selling to an ESOP. Could you speak to that benefit a little bit?
So there's a transaction, a way to structure a transaction. It's called a 1042 transaction. That if there are a number of requirements that need to be met. Of course, you have to sell a certain percentage of your stock. It's 30% to the ESOP, and other requirements that have to be satisfied. But if all the technical requirements are satisfied, when the sale occurs, rather than paying gain at the time, capital gains at the time that the sale takes place, any sale is deferred so the income to the selling shareholder is deferred at the time of the sale if the proceeds of the sale are invested in what's known as qualified replacement property, which is essentially just securities of domestic corporations. So, buying stock on the stock market, essentially, or bonds. It's a huge potential tax benefit because, number one, the sellers can sell their stock in the company, get this tax deferral, and essentially they're not going to pay taxes on the sale proceeds until that qualified replacement property is disposed of. There's a second potential benefit, which is if the selling shareholders have sufficient resources that they don't have to dispose of that qualified replacement property during their lifetime, if they can hold it until their death, then they get what's known as a step up in basis. So when they leave that property to their beneficiaries, the beneficiaries will get a step up in basis, so that essentially no one ends up paying taxes on those sales proceeds. So that is a potentially huge benefit for the selling shareholders. Now, one thing I will say, we talked earlier about the types of corporations that can sponsor ESOPs, either C or S corporations. That type of transaction, the 1042 transaction, only works if you have a C corporation. So that's one thing to keep in mind. But if you have an S corporation and you want to go the S corporation route, there are other tax advantages that to the corporation going forward that can benefit the company going forward, which also can impact the potential sale price. So there are other tax benefits to be considered in addition to just this 1042 transaction. But in terms of the selling shareholder, that is a potentially powerful tax incentive.
Excellent. So, obviously ESOPs are quite extensive. If the company is not ready or able to venture into ESOPs, are there other forms of employee ownership programs that would be options for them to explore?
Dave, I know you'd mentioned that one of the things that Jerry considered was selling the company to you and Mike, members of management. So management buyouts, that's always another option. If there's a management team in place that has an interest in purchasing stock of the company and has the wherewithal to do it, that's something we see where management will buy the company from the existing shareholders. So that's always an option. There are other mechanisms that you can get maybe not actual stock into employees' hands, but you can get sort of the same types of benefits. So there are things like stock appreciation rights, phantom stock, that get an equivalent of economic. It's really some of the economic benefits of owning stock into the employees' hands without actually having them having to buy the stock. So now that while that gets some of the benefits of ownership into the employees' hands, you still have the issue of who does the selling shareholder end up selling the company to. They still have to find a buyer if they want to sell the company. But if the goal is to get some of the benefits of ownership distributed or given to the employees, there are other types of arrangements like that are out there that could be utilized. Another thing that I'm sure everybody is aware of would be stock options. So you can always issue stock options to your employees to buy stock in the company, and that's another thing that we see typically that's done. But again, if you've got a selling shareholder who wants to exit the business and sell the business, that's not a total solution. It only addresses getting some of the ownership to the employees.
Well, this has been very educational. Before we close, Dave, did you have anything else you'd like to add to the discussion?
Well, if you're interested in moving forward with trying to determine if there's an ESOP deal in your future, you can contact me through ATA or PAMA. I can get you in contact with the law firm that we used for our deal, and kind of get you going down the right path to make a decision on whether or not an ESOP is right for you.
Fantastic. Doug, any final words?
Well, I'd just like to reiterate Dave's comment that what I've seen a lot of times with companies that are exploring ESOPs, the ESOP community is a pretty tight-knit community. So whenever somebody's has questions about ESOPs, in addition to these conferences, reaching out to other ESOP companies is a really valuable resource. Again, just because it's such a sort of a unique way to go about a sale and a transition of a business, there's such a learning curve. I think that people who have been through it are really willing and able to help other people that are exploring that. So I would encourage people to reach out, to folks like Dave or other ESOP companies, because what I think you'll find is they'll be very willing to talk to you and share their experiences.
Wonderful. It's great advice. Well, gentlemen, thank you both so much for being a part of this podcast today. We appreciate your insight and your knowledge and your information. This has been a very interesting and educational discussion. So thank you both for participating.
Thank you, Charlene.
Thank you.
Thank you for joining us on this episode of ATA Talking Textiles. ATA is a not-for-profit association representing the international specialty fabrics marketplace. Learn more about events, workshops, and webinars ATA hosts throughout the year at textiles.org/events.